Hey, welcome to The Explainer. So, I want you to imagine a loan for a second. But instead of being about profit, its entire purpose is just to help. It sounds pretty radical in today's world, doesn't it? Well, today we're going to dive into a financial contract that's built on that exact idea, an economy of pure compassion. Let's really start with this question right here, because it's the key to everything. What if the whole point of lending money wasn't to make more money, but was simply about giving someone a hand when they need it most? This idea, it's the foundation of the entire concept we're exploring today. So, what does a loan without profit actually look like? Well, at its core, it's a loan where the very idea of charging interest or demanding any kind of pre-agreed benefit for the lender is completely and totally off the table. The official term for this is al-Qardh. And the name itself has this really powerful, almost poetic meaning. Linguistically, Qardh means to cut off. It's this idea that a lender is literally cutting off a piece of their own wealth to help someone else out, with the simple understanding that they'll get that exact same piece back. Nothing more. Now, this quote, this really shows you the profound ethical weight behind the whole concept. You'd probably assume that straight-up charity is the highest form of giving, right? But this teaching suggests that a benevolent loan can be even more rewarding. And the reason is fascinating. Someone asking for a loan is in a very specific, urgent state of need, and helping them this way empowers them while preserving their dignity. Of course, a contract this unique isn't just some informal handshake agreement. It has a really clear set of rules. We can call them pillars and conditions that make sure it stays fair and actually serves its purpose. For a Qardh contract to even be valid, it has to stand on these 4 pillars. It's pretty logical, really. You need a lender and a borrower. You need the actual thing being loaned, the subject matter, which is usually something like money. And finally, you need a crystal clear offer and acceptance. If any one of those is missing, the contract just doesn't exist. And this diagram just shows the beautiful simplicity of the whole thing. Person A lends to person B. Then, down the road, B returns the exact same amount. That's it. No extra fees, no interest calculations, no hidden charges. It is a clean, direct, one-to-one exchange, with the only thing between them being time. Let's just zero in on a few of these conditions because they're absolutely critical. First, once the loan is given, the ownership of that money actually transfers. It becomes the borrower's to use as they need. Second, the repayment has to be an exact equivalent. And this last one is huge. A lender can never add a penalty fee for late payment. That's just strictly for. And that brings us to maybe the most important ethical boundary in this whole contract. It's a very firm, very bright line drawn in the sand against something known as riba. Here it is. This is the golden rule. Any pre-agreed increase or benefit that the lender writes into the deal is considered riba, or usury, and it's forbidden. It doesn't matter if it's a tiny amount. The principle is absolute. The loan has to be an act of help, not a vehicle for personal profit. This famous legal maxim just sums it all up perfectly. And the key word here is benefit. We're not just talking about demanding extra cash. It could be asking for a service, or a gift, or really any kind of advantage that's tied directly to the act of giving that loan. Okay, but this is where we see a really important nuance. Let's say a borrower, just out of pure gratitude, decides to repay the loan with a little extra something, a small gift, maybe a bit more money, without any prior agreement. That's actually seen as a good thing, a commendable act. The prohibition isn't on the extra amount itself, it's on the stipulation, the lender demanding it as a condition from the start. So to make sure this is all crystal clear, it really helps to distinguish al-Qardh from some similar ideas. Is it just another word for debt? Or is it more like borrowing a tool from a friend? Let's break down exactly what makes it different. This table clears things up so well. A Qardh is a loan of something that can be replaced, like money, and the ownership transfers. Dain, or debt, is a much broader term for any obligation, and it often comes from a business deal, like a sale, where profit is totally legitimate. And then you have arya. That's just borrowing a specific item, like your neighbor's ladder. You use it, and you give back that exact same ladder. With Qardh, you return an equivalent amount of money, not the exact same dollar bill. Okay, so you might be listening to all this and thinking it's a nice historical idea, maybe a bit theoretical. But the thing is, it is very much alive and well in the modern financial world. Let's look at some real examples. Just take Malaysia, for instance, where the Qardh model is a real cornerstone of ethical finance. It's used by microfinance groups to give entrepreneurs a start without burying them in debt from day one.
Banks use it for their employee welfare funds. You even see it used in Islamic insurance and by major charitable institutions. So yeah, this is a practical, working model for compassionate finance today. And this really gets us to the philosophy behind it all. Because this contract isn't just a set of financial rules, it's a framework for building a more just, more supportive society. Ultimately, what you have here is a system of mutual responsibility. The lender has a duty to be compassionate and lenient, but, and this is just as important, the borrower has an equally serious duty to be sincere and to repay on time if they're able to. It's a contract that's truly built on mutual trust. The lender's side of the bargain is laid out so clearly in this verse from the Quran. It basically tells them, if someone owes you money and is struggling, give them more time. And you know what? If you can afford to, forgiving the loan entirely is even better. But here's the counterbalance, the other side of that coin. This system is not meant to be abused. For a borrower who has the money to pay it back but just doesn't, that delay is described as an injustice. The obligation to honor your commitments is taken just as seriously as the lender's obligation to be kind. So, all of this leaves us with one final and I think really important question to think about. In a global financial system that is so fundamentally built on interest and profit, what can we learn from an economic framework where compassion isn't just a nice little bonus, but the actual engine of the entire transaction?